Hello friends, how are you all? So let us continue on our lesson number 15. This is the fourth video and we are studying the economic reforms from the last one or two lessons. So basically see, in the previous video we have already studied about the Narasimhan-I Committee. Okay. So Narasimhan-I Committee was a committee on reforms in financial sector, and that committee was set up in 1991 immediately after the balance of payment crisis in India to recommend what changes, what reforms we need to bring in the financial sector of India. Then again after 7 years in 1998, Mr. Narasimhan was asked to head another committee to again suggest reforms in the banking sector. Okay, so that is known as Narasimhan Committee 2, second Narasimhan Committee. So we are going to study about that in this video. Okay. So what were the major recommendations of the Narasimhan Committee 2? I have already told you the background of this. It was on banking reforms, right? So it recommended reforms in the banking sector. And why is banking sector important? We already know, because banks provide the institutional credit to the businesses, to industry, right? So that is the reason why we needed to have a thriving banking business in our country, so that there is flow of capital, there are investments, and the businesses will flourish. So what was the first recommendation of the Narasimhan Committee 2? That it said that there should be a capital adequacy ratio, and it needs to take into account market risks along with the credit risk. Okay, so see what happens is, what is a capital adequacy ratio CAR, that I'll try to explain to you in a very simple way. So capital adequacy ratio CAR is basically the ratio of bank's total capital divided by the risk weighted assets of the bank. Now I'll explain it to you, what is bank's capital and what are the risk weighted assets. If you understand this, you will get to know what is capital adequacy ratio. So see, bank's capital is basically, bank's capital is nothing but a bank's, okay, is nothing but a bank's total, okay, it's a bank's total capital with which it is running its business. Okay, now again maybe this is a little confusion for you, what all is there. See, bank's capital is nothing but a bank's total capital, meaning total money, capital meaning money, with which it is running its business. For example, you are opening a business. Okay, so if you are opening a business, say for example you are for example your total investment, or the total initial investment that you are doing is say rupees 100. Okay, I again and again give you this example. Out of this 100 rupees, for example 20 rupees is your own money. Okay, you yourself, the promoter, you are the promoter of the business, you are putting 20 rupees as your own money. Okay, then after that what you do, you issue shares in the market and you obtain another 30 rupees from issuing the shares. Okay, and another 50 rupees you are taking as a loan from the market, as a loan, or bonds or debt that you are issuing. So like this, you are having a total 100 rupees as your capital. This is your capital to do your business. Similarly, in order to start a banking business, right, if you want to establish a bank, you need to have some capital, minimum capital. So that capital requirement, that total capital is known as a bank's capital, and there are different classification of that bank's capital that we'll see, that is tier 1 and tier 2 capital. We'll see what are those. So capital adequacy ratio is basically the bank's total capital, meaning the total money with which it is running its business, in a very simple terms, divided by the risk weighted assets. Now what are the assets of a bank? That we already know. Okay, see, I'll write it here. So assets of a bank are what? See, whatever the loans a bank is giving, that is basically the asset of the bank, because the bank will receive that money back in future. For example, if a bank is giving loan to Reliance company will pay that loan back to the bank. So that is why it is considered to be the assets. Now every loan that banks are giving thousands of loan. It is giving loan for a purchase of vehicle, for house, for business, for so many different things. So it is giving thousands of loan. Every loan has some risk attached to it, right? Risk meaning, in simple terms, what is the probability that this that this loan will be defaulted? That is the risk. For example, if you are giving 100 rupees loan, okay, 100 rupees loan to say Reliance company. So since Reliance company is in a very good financial health position, the risk of default is say very very low. For example, only 2%. So there is a 98% probability that this loan will come back. Okay. Then say for example you are giving another 50 rupees loan, okay, another 50 rupees loan to another say XYZ company, and now this company, there is a risk that there is a 10% chance that this company will default. So there is a 90% chance that this 50 rupees will come back. Okay. Similarly, for example, if a bank is giving 5 rupees loan to a farmer, or to say any common man, for purchase of say house, okay, for purchase of house. Now say for example that there is a only 50% chance that this loan will come back. Okay, I'm just giving you a hypothetical example. So the risk of default is 50% here, and there is a 50% probability that this 5 rupees will come back. So what happens is that these assets are having risk. Okay, it is not 100% sure that all the loans will come back. So what the banks do is the bank will calculate its risk weighted assets. Okay, risk weighted assets, RWA, means what? For example, if there is a 98% probability that this 100 rupees will come back, so they will multiply this 100 by 0.98. Okay, by 0.98. So this is the probability that this money will come back. Plus, if there is a 90% chance that this 50 rupees will come back, so they will multiply this 50 by 0.9, because this is 90% probability. Plus, if there is a 50% probability that this 5 rupees will come back, so 5 multiplied by 0.5. Okay, and so on. So like this, it will calculate all the risk weighted assets of the bank. Okay, whatever it has lent, or there are different kind of securities also that it may have invested in. So that is a risk weighted asset of a bank. I hope you have understood what is a bank's capital and what is a risk weighted asset. See, bank's capital will be utilized when for example, if a bank goes bankrupt, or if there is a bank run, suddenly all of the people are going and wanting their money back from the bank, whatever they have deposited. So bank will definitely use its bank capital to give the money back to the people, because that is what are the liabilities of the bank, and risk weighted assets are the assets of the bank which it will come to it. So there we have to find a ratio, as what ratio we are maintaining about this. So see, in this what used to happen, this risk weighted assets previously they used to consider only the credit risk. Okay, what is the risk of somebody defaulting? So that is known as a credit risk. But definitely there are market risk also. For example, as in this example, say this loan given to the Reliance company. Okay, now this Reliance company, because the company is in a sound health, financial health, there is a 98% chance that it will give its money back. Okay, but that is, we are only looking at the reputation of the Reliance company in that sense. But what happens if in overall market there is recession? Okay, what happens if there is a recession in the overall market? If in the there is some kind of recession, if there are some market failure, or that business suddenly stops, or there is no demand, what if something happens? So that is known as market risk. Market risk is something that applies to every company. There is no fault of that individual company. So without any fault of say Reliance company, what happens if this probability reduces to only 90%, right? Because there are market risks, you never know what will happen in the market. So the Narasimhan committee said that along with the credit risk, we also need to consider the market risk while calculating the risk weighted asset and finally the capital adequacy ratio. Okay, I hope you have understood this. So that was the first thing that he said, and this was to ensure that the banks have sufficient assets and liquidity. See, if you are overestimating if you are overestimating your assets, for example, if you are overestimating your risk weighted assets, definitely you will feel that the condition is good. But there are other risks also, like market risk. So if what happens if the market risk actually become a actual threat to the banking industry? So they said that in order to have a good liquidity so that the banking system don't fail, they say that we need to be more stringent, more strict with the capital adequacy ratio requirements. Okay, so that was the first one, and definitely all this was following the Basel norms actually. Okay, Basel norms. So we, Basel norms, for simplicity, I'll tell you. Basically, there is we know that there is a bank for international settlement in based in Basel in Switzerland. Basel is a city in Switzerland, and these Basel norms are basically the norms which say how a banking industry should be regulated by a country. Okay, what should be the capital adequacy requirement, then what should be the minimum standards of lending, how the banking should do the KYC, and all those things they recommend. Okay, that is about the Basel norms, and definitely Narasimhan committee was taking cues from the Basel norms only when it was suggesting about the capital adequacy ratio. So this was the first point. Then the second one was that the banks permitted to issue bonds for augmenting their tier 2 capital. Okay, now I'll explain to you what is a tier 2 capital, tier 1 capital. As I have told you, this bank's capital, okay, this bank's capital, basically this bank capital consists of different levels or different types of capital. So the first one is known as tier 1 capital, then tier 2 capital, and tier 3 capital. Okay, friends, see this TIER, it is pronounced as tier, not tire. Okay, so this is tier 1 capital. Tier 1 capital is a capital which is known as the core capital or the high quality capital. Okay, high quality capital meaning highly liquid, highly it is assured that the bank will get this capital whenever it wants to. So it is high quality core capital. In tier 1 also there are two types of capital. One is known as common equity, okay, and second is additional tier 1. Okay, apart from common equity there is some more capital in that is additional tier 1 capital, and we have heard these terms previously when we are studying lesson on monetary policy and banking system in India. I'm sure you remember this, that too big to fail banks or systemically important banks, they need to have additional tier 1 capital of this. So this we have studied, so that only I'm trying to explain it to you. It is a part of the bank's capital, tier 1. In tier 1 there are two, common equity and additional tier 1. So common equity meaning what? Common stocks. Okay, the stocks that the banks has issued in the market, right? For example, HDFC Bank, so there are stocks in the market, so that is common stocks. Then retained earnings also, I know all of you know, we have discussed this in the previous lesson, what are retained earnings of any company. So just bank is also a company, right? It is also a corporation, so it also has retained earnings which is which becomes a part of its capital. So retained earnings, etc. So good quality capital, core capital comes under the tier 1. Then what comes in tier 2? Tier 2 is basically supplementary capital. Okay, it is little bit less, it has little bit lesser quality than the tier 1 capital. So it is known as supplementary capital, and it consists of subordinated debts, hybrid instruments, revaluation reserves. Revaluation reserves meaning, say for example, if a bank is holding in its reserves as gold, so gold prices changes, so every 2 years, 5 years, maybe it is doing some revaluation. For example, when it had the gold reserves, the price was 25,000 okay, for gold for per 10 gram, but now the prices has increased to 35,000. So that revaluation reserves, that also becomes a part of the bank's capital, bank's balance sheet. So that also comes here, and it is not a very assured capital, that's why it is kept in tier 2. Then similarly there are some hybrid instruments, like hybrid instruments meaning instruments which are both debt and equity, which can be convertible and all those things. So that is hybrid instruments. And subordinated debts. What is a subordinated debt? See, the name itself suggests, here I have written it. Subordinated debt is a loan that are paid off after all corporate loans and debts are repaid in case of default. For example, this bank has issued some bonds. Okay, the banks have issued the bonds or debts. Okay, but these debts are subordinated debt. Subordinated debt meaning junior debt. These are known as junior loans. They are unsecured. Okay, and since they are unsecured loans, there is a high risk that the bank will not pay back this loan in case of a default unless and until all the senior loans are paid off. Okay, so just keep in mind that subordinated debt are a low quality debt. Okay, low quality debt, and it is paid off after the senior loans are paid. They are unsecured loans, that's why it is kept in tier 2. And then there is a tier 3 capital also, but it is being abolished under Basel 3 norms. Basel 3 norms came in 2010, and now it is being abolished. They say that we don't need to have tier 3, so there is now just only tier 1 and tier 2. So the bank's total capital is basically the tier 1 plus tier 2 capital. That is the bank's total capital. Now tier 1 capital, to understand it in a simple terms, tier 1 capital is basically the capital which even if lost, banks can perform its function, okay, because it is a good quality capital, and if there is any sudden risk in the banking industry, so banks can tap into that capital and it can still go on with its business, okay. And the moment tier 1 capital is exhausted, banks are at the risk of becoming insolvent, okay, because the good quality capital, the money that it was supposed to be relying on is now over, has now exhausted, and now it has to tap to tier 2 capital, which is not a very assured capital, okay. So there is a risk. So banks capital adequacy requirement, which is tier 1 capital, tier 2 capital, this is the total capital divided by risk weighted asset. If it is not maintained properly, it means that the banking industry or that particular bank is not in a proper financial health, okay. So we were studying about the Narasimhan-II Committee. So its recommendation was on capital adequacy ratio, and the banks permitted to issue bonds to augment the tier 2 capital. So now it said that we should allow banks to issue bonds or debts to as a part of the tier 2 capital, okay. So that was the recommendation. Then another recommendation that Narasimhan-II Committee gave was on narrow banking, okay. It said that banks were allowed to put their funds in short term and risk free assets for weak public sector banks, okay. So it said that there are some public sector banks which are weak and which have very high NPAs. So they said that now the government should tell them that you should put your funds only in short term loans and risk free assets, okay, where the no asset is risk free, but comparatively very low risk, basically just lending to a very secure and very credit worthy borrowers. So it said that we should adopt a narrow banking for some of the public sector banks. Don't let them diversify their portfolio, giving high risk loans to some people which may default. So that was a recommendation. And the most important part of Narasimhan-II, contribution of Narasimhan-II, was that it finally led to enactment of the SARFAESI Act 2002, which led to the legal basis for the ARCs. ARCs is your asset reconstruction companies, okay, asset reconstruction companies. We are going to study about this also in the next video, what are ARCs. So basically finally there was a legal basis for asset reconstruction of NPAs of a bank, and it led to SARFAESI Act, which provided the legal basis for kind of recovering the loans from the bad borrowers or people who are defaulting, okay. We'll discuss about the SARFAESI Act, what is there. Then another recommendation of Narasimhan-II Committee was on segregation of RBI's role as a regulator as well as the owner of the banks. See what happens if a particular organization, say RBI, is a regulator of banking industry, okay, and it is also owning some of the banks. So see what is here happening there is a conflict of interest. Right, conflict of interest is happening here because you are only regulating and you are also owning some of the banks. So it may happen that you are favoring your banks which are owned by you, and there is a conflict of interest. So regulator and owners, they had to be separated. So that was a very good recommendation of Narasimhan-II Committee. They said that we should segregate, we should separate RBI being the regulator and owner of the bank, and let RBI only be the regulator, not the owner. So it recommended the RBI should disinvest or divest its holding into banks and financial institutions like SBI, NABARD, NHB, etc. And ever since, RBI has divested its equity holding in these institutions, and it has now become only the regulator, not the owner of this particular organizations. Okay, liquidity adjustment facility, which was repo, reverse repo, was also introduced, was also recommended, which was later adopted in India. Okay, but it was also introduced by Narasimhan-II Committee. And one more another suggestion was that it recommended there should be professionalism in banking sector, right? Okay, there should be merit based selection, campus recruitment, staff training should happen, etc. People should behave professionally, they should have the knowledge of finance and banking, etc. Right? So this was also recommended, and ever since the recruitment changed, and there are competitive exams, and campus recruitments also happen, then very intensive trainings happen for the banking staff. So all these things were recommended by Narasimhan-II Committee. Now let us study about the SARFAESI Act of 2002. Now what is this SARFAESI? Okay, SARFAESI is basically an acronym for a very big name which even I don't sometimes remember. So SARFAESI, the full form is Securitization and Reconstruction of Financial Assets and Enforcement of Security Interest Act. Okay, very big name, very difficult to learn and remember, but if you understand the meaning of these terms, I am sure it will be easy. I'll explain it to you what are the meaning of these different terms and what was the purpose of this act. It was basically an act to recover bad debts. Okay, as I have told you, the debts which were NPA, which were stressed assets of the bank, this act was basically to provide a legal framework for the banks to recover the bad loans from the defaulters. Under this act, India's first asset reconstruction company, which was ARCIL, ARCIL, was established. Okay, this is important. You may want to remember this. ARCIL, which is Asset Reconstruction Company of India Limited. ARCIL. ARCIL was established as the first ARC in India under the SARFAESI Act. Please remember this. Now let us understand the name. Okay, let us understand the name of the act. Okay, SARFAESI. What is the meaning of each and every term in this? So see, the first word is securitization. See, securitization and reconstruction of financial assets. So what is securitization? Securitization means to ensure that a thing deposited or pledged as a guarantee be forfeited in case of default. Very simple meaning. For example, if you are putting a gold chain as a collateral, okay, or as a security in a bank against a loan, then it means the securitization process means that the thing that you have deposited, that is a gold chain or placed as a guarantee, be forfeited in case of default. For example, if you are defaulting on your loan, you are not paying back your loan, then it will be forfeited. Forfeited meaning it will be taken into our custody forever. It will be with us. So that is the meaning of securitization. Then what is reconstruction? Okay, reconstruction of financial assets. Reconstruction meaning it is a process of converting bad assets into cash. For example, if there is a loan given to say Reliance company, it is not paying back. Okay, so you need to do some negotiations with that. So basically you are reconstructing that asset. For example, you are given 100 rupees. Now you are trying to renegotiate and you are saying that okay, you pay at least the principal amount, you pay us at least the 90 rupees. So out of 100, at least you are trying to recover 90. So that is reconstructing your asset, okay, in different way. So you are converting your bad assets into cash, okay, basically to clean up the balance sheet. Okay, now for example, what happens, all these assets are part of the bank's balance sheet. So we know what is a balance sheet. Here there is assets, here there are liabilities. In the assets there are all the loans given by the banks. Now for example, if out of the 10 loans, 2 loans are bad loans. Now because of 2 bad loans, the quality of assets is very bad. Okay, the balance sheet is in a bad condition. So if these 2 bad loans are purchased by some another company, the ARC, okay, they will say that okay, I'll pay you this much, you transfer this loan to my account and I will recover it from the Reliance company. Okay, whoever is the bad whoever has the NPA, I'll recover it from him. So basically what happens is ARC company is taking off this bad assets from the balance sheet of the bank to its own balance sheet, because that is what is its business is, and it is cleaning up the balance sheet of this bank. Okay, so it is to clean up the balance sheet. That is known as reconstruction. So right, so securitization we know, reconstruction of financial assets we know, it is basic financial assets meaning the loans and the debt that you have given. And enforcement we know, what is enforce? To enforce means to legally put into force. Okay, by the order of court or by law you can enforce something, okay, because you have the power to enforce it by law. So what is security interest? Okay, enforcement of security interest. So security interest basically means the collateral or a pledge kept against the loan. It is nothing but the collateral or pledge that you have kept against a loan. For example, the gold chain. So that is the security interest. So you have to ensure that the security interest is enforced. Financial assets can be reconstructed, financial assets can be recovered, it can be securitized. So that was the purpose of this act. Basically, the act permits banks and other financial institutions to recover loans by auctioning defaulters' residential and commercial assets. So how a bank will be able to securitize the bad loans? By auctioning it, right? By selling it in an auction and recovering the money, whatever it gets. Unsecured loans, now see, but there are some exceptions. Okay, unsecured loans, that is again these are the subordinated debts. Okay, subordinated debts given by the banks. Okay, subordinated debts given by the banks, not the bank's capital. These are the subordinated debt given by the bank, not taken by the bank. Okay. Unsecured loans, loans under 1 lakh rupees, and debts that are less than 20% of the initial principal are exempt from this act. Okay. So not for example, if a bank is for example, a bank, for example HDFC, had given say 10 crore rupees, 10 crore rupees as principal to say Tata company. Now out of this 10 crore rupees, Tata company is paying back. Okay, now the principal amount that is left is only 1 crore rupees. Okay, after say 5 years, and now this 1 crore rupees this Tata company is not able to pay. For example, if it is not able to pay this 1 crore rupees, now this 1 crore rupees is only 10% of the original principal amount, right? Because original was 10 crore, now only 1 crore is left, so it is only 10% of the original principal amount. It has paid back the 90%. Okay, because of some issues, because of some problem, maybe it is not able to pay back the 10%. So a company cannot use the SARFAESI Act against this. Okay, because it is less than 20% of the initial capital. And if the loans are under 1 lakh, so SARFAESI Act cannot be used if the loans are less than 1 lakh rupees, if it is a small loan. And for unsecured loans, obviously because the bank itself had given unsecured loan, you cannot use this act. So these are the exemptions. Now I'll tell you practically how it happens, because being an IAS officer, I have seen many cases of SARFAESI Act, and basically how it happens I'll tell you. Basically, see, the process starts with that the borrower fails to pay back a loan or an installment. Okay, that is how the process starts. For example, if somebody had taken loan from the bank and it has failed to pay back the loan or one of the installments of the loan. Okay, now the banks will classify it as NPA. The banks will say that since this installment has failed, the borrower has not paid back, it will classify it as NPA, non-performing asset. Then the banks gives notice to the borrower up to the limitation term. Okay, it says that these are the 60 days or 90 days within which you pay me back. Okay, and the secured creditor meaning the bank only, basically the institution, the financial institution which has given secured loan or secured credit is known as secured creditor. So it can be an NBFC, it can be banks, okay, it can be anything, but it has to be secured creditor, not unsecured creditors. Institution which has given secured loans is known as secured creditor, okay, against which there is some security. Okay, so that is known as secured creditor or banks. So secured creditor, once it is classified as NPA, the banks will give notice to the borrower to pay back the loan up to the limitation term. So these can be 90 days, 60 days, like that. Then borrower gives, for example, if the borrower is not able to pay back the loan, then the borrower is given notice under the SARFAESI Act of 60 days. So there is a limitation term. Okay, for example, this month you are not able to pay your installment, it will initially give a notice under the limitation term, okay, that you pay in maybe another 2 months or another 30 days, 90 days. If it is not, then it gives notice under the SARFAESI Act. Okay, so for SARFAESI Act, again 60 more days are given to that person to pay the money back, and the notices are also issued to the guarantors of that person, right? Notices are also issued to the guarantors. Simultaneously, the notices are also given to the collector of the district. Okay, notice in the sense that they inform the collector of the district that this kind of loan is pending with this person, and we have issued notice to him under the SARFAESI Act, and if he fails to pay back within 60 days, then we may have to auction his property, we may have to forfeit his security interest. Then banks write to the collector of the district and then takes control of loan security. Okay, loan security meaning the land, house, property, whatever. And then it can sell, lease, auction the property. It can take possession of that property, and then it can sell, it can give on lease, it can auction the property, whatever it wants. Okay, definitely there are more legalities to it. It is not that simple, but this is a very simple procedure that I'm telling you. See, why collector is informed? Because see, there may be a problem of law and order. People may start protesting against it, or there may be some different kind of law and order issues. So collector has to be informed. Then since they are auctioning the properties, the maybe land and all those things, so the land records, everything is maintained by the collector. Everything has to be done through the collector office, through the tehsil office, through the revenue administration. So basically collector has to be informed that these kind of things are happening in your district and we are going to do this. So and then the collector permits that okay, this can be done. So this is how the procedure happens within the SARFAESI Act. I'm sure you must have understood what is the purpose of this act, how it happens, okay, the meaning of each and every term in the name of the act. So okay, with this I'll stop with this lesson and we'll continue in the next video. Thank you.